Hey everyone, and welcome. So, have you ever actually wondered what the difference is between starting to invest at age 25 versus, say, waiting until you're 35? Well, you're in exactly the right place. We're going to break down how a simple 10-year delay could cost you over 60 lakh rupees. And more importantly, why starting your investment journey right here in India right now might just be one of the best financial moves you ever make. Let's jump in. Okay, let's kick things off with a pretty straightforward question. Imagine two friends. They both invest the exact amount of money for the same number of years. The only difference, one starts at 25 and the other waits until 35. Now, 10 years, it might not seem like a huge deal, right? But as you're about to see, the impact on their final wealth is, well, it's massive. Just take a look at the scale of this. It's pretty staggering. By investing just 3,000 rupees a month for 10 years and then just letting it grow, the person who started at 25 could end up with around 1.2 crore rupees by retirement, and the one who waited until 35? About 45 lakhs. We're not talking about a small gap here. This is a life-changing difference. Let's just put that number front and center. We are talking about a difference of over 60 lakh rupees. That is the potential cost of waiting just one decade. And listen, this isn't some kind of financial magic trick. It's the pure, simple power of starting early. And we're going to show you exactly how it all works. So here's the thing. Waiting doesn't just cost you those potential future earnings. There's another, much quieter force at play that is actively eating away at the value of the money you have right now. And that force is inflation. You know, the best way to think about it is like a slow, invisible leak in your financial bucket. With inflation hovering around, say, 6%, that 1 lakh rupees you have sitting in a savings account today, well, in just a couple of years, it's only going to buy you what about 87,000 rupees would buy you today. Your savings are literally shrinking. And this really drives home the point of why you almost can't afford not to invest. See, it's not just about getting rich. At its core, it's about protecting the value of the money you already have. Investing is really the best tool we have to fight back against inflation and actually grow our purchasing power over time. Okay, so we've laid out the problem. But the good news? The solution is right in front of us. Honestly, the Indian economy right now presents one of the most exciting opportunities for new investors that we've seen in a very, very long time. Let's start with this one number, 8.2%. What is that? That's India's GDP growth rate. In a world where so many major economies are slowing down, India is a real engine of growth. And that kind of economic expansion creates the perfect environment for investments to really do well. So why is right now, in particular, such a great time to start? Well, it's really a perfect storm of positive factors. You've got that strong GDP growth we just mentioned. You've got policy stability, which markets love. You've got new regulations from SEBI that are making investing safer for people like you and me. And you know what? You're not alone. There are over 16 crore Demat accounts in India. That means millions of people are already on this journey. All right, let's get back to that 60 lakh rupee difference we saw at the beginning. What's the secret sauce? It's a concept that Albert Einstein supposedly called the eighth wonder of the world, and that is compounding. To put it really simply, compounding is your money making more money for you. So in year one, you earn returns on what you invested. But in year two, you earn returns on that initial amount plus the returns you made in year one. Over time, this creates this incredible snowball effect, making your wealth grow faster and faster. And this leads us to probably the single most important rule for anyone looking to invest for the long term. Forget about trying to guess the market's highs and lows. The real secret is just giving your money as much time as possible to let that compounding magic really work. Want a cool way to see compounding in action? It's called the Rule of 72. It's a fantastic little mental shortcut. All you do is take the number 72 and divide it by your expected annual return. The answer is roughly how many years it'll take for your investment to double. Simple as that. Let's look at this in practice. If you're earning 6% in a fixed deposit, your money's going to take about 12 years to double. But let's say you're in equities, which have historically averaged around 12% in India. Well, now your money could double in just 6 years. That difference is how you build serious wealth over time. Okay, so this brings us to a really important choice for every new investor in India. Where should you actually put your money? Let's compare the two most common starting points, the safety of fixed deposits, or FDs, and the growth potential of equity. Now, on the surface, it seems like a pretty simple trade-off, right? FDs give you that feeling of safety with guaranteed returns, but they get taxed pretty heavily. On the other hand, equity, which just means buying a small piece of a company, offers much higher potential returns and is generally more tax-friendly, but it does come with market risk. For beginners, a great way to start is through index funds, which let you buy a tiny piece of many of India's top companies all at once. So here are the gross returns, the numbers you see advertised. An FD might offer a solid 8%. Equities, based on historical averages, could deliver something closer to 14%. Right away, equity looks like the winner. But the real story is actually even more dramatic. And this is what happens when we factor in reality, things like taxes and inflation. Let's assume a 30% tax bracket and 6% inflation. Suddenly, that 8% return from your fixed deposit becomes a negative 0.4% return. You are actually losing purchasing power. Meanwhile, the equity investment, even after taxes and inflation, is still giving you a positive real return of 6.5%. This is the hidden danger of playing it too safe. So, you get the urgency, you see the massive opportunity, and you know where the real growth is hiding. The question is, what's the very next step? Well, it's actually incredibly simple. You just need to open a Demat account. Look, the days of complicated paperwork are long gone. Today, you can get your Demat account, which is basically just a digital wallet for all your investments, up and running in 24 to 48 hours. Seriously, you just choose a broker online, upload your documents, do a quick e-verification, and boom, you're ready to go. And what do you even need for this? Just the basics. Your PAN card, your Aadhaar card for a super easy electronic verification, and your bank account details. That's it. There are almost no barriers left to getting started. So let's just bring this all back home with this one quote, because it really is the main lesson here. The secret to building wealth isn't about being a genius who can predict the market. The secret is just starting as early as you can and letting the power of time and compounding do all the heavy lifting for you. We've covered a lot today, right? From the huge cost of just waiting a decade to the simple steps you can take today. So the final question is really for you. Now that you know all this, what's holding you back from taking that first step? And of course, just a quick reminder, everything we've talked about here is for educational purposes. Investing always involves market risks, so it's a great idea to talk to a SEBI-registered financial advisor who can help you with your personal goals before you make any decisions.